Welcome, everyone, and thanks for being here. Today, we're going to talk about something that touches almost every HR and payroll team right now: wage and hour risk in remote and hybrid work. I want to set the tone before we start. This isn't a session about whether remote work is good or bad, it's about a quieter problem. The rules for paying people didn't change when work went remote, but the way those rules get broken changed completely. The exposure moved into places you can't see from a desk, into chat apps, home offices, and payroll settings that nobody revisits. This is built for the people who actually live with this every day: HR generalists and business partners, payroll, compliance, employee relations, and the frontline managers who supervise remote and hybrid teams. Wherever you sit in that group, you'll leave with concrete things to check. One ground rule: everything today is educational. I'm going to reference federal law, agency guidance, and some real court decisions, but none of this is legal advice, and your own counsel and your specific state rules always win. With that said, let's get into it. Let's start with why this topic is getting so much attention right now. Here's the thing that surprises a lot of people. Remote work didn't create new wage and hour law. The Fair Labor Standards Act, the state break rules, the overtime math, all of it is exactly the same as it was when everyone was in the building. What changed is visibility. A manager used to be able to glance across the floor and see who was still at their desk at 6 o'clock. That signal is gone, and the obligation didn't go with it. The first thing to understand is that this risk is quiet. It almost never shows up as a dramatic event. It shows up as a few unrecorded minutes a day: a reply to a Teams message at 9 at night, a working lunch that wasn't really a break. On its own, each one looks like nothing. But wage hour exposure doesn't live in a single day. It lives across a whole workforce and a multi-year look-back window. And that's where small becomes large. The second thing: the risk is concentrated in your non-exempt employees. For anyone who's non-exempt, every hour they actually work has to be captured and paid, and overtime kicks in past 40 hours in a work week. Working from a kitchen table doesn't change that math one bit. And the third thing: a distributed workforce is, by definition, a multi-state workforce. The moment your people are scattered across state lines, one single payroll practice can run into several different states' break rules, reimbursement rules, and overtime rules all at the same time. So when these problems surface, they rarely arrive as a polite complaint. They surface in an audit, in a termination, or in a class action, usually long after the habit's formed. To keep us oriented, let me lay out the 7 places this risk tends to live. Think of it as our map for the session. Almost every remote wage hour problem I've seen traces back to one of 7 areas, and we're going to walk through all of them today. The first is hours you simply can't see: after-hours messages, early logins, the little tasks that never make it onto a timesheet. The second is timekeeping that drifts. Because remote time relies on self-reporting, and rounding and the gap between scheduled and actual hours start to matter. Third are breaks that aren't really breaks: interrupted lunches and missed rest periods in the states that mandate them. Fourth is classification pressure: the temptation to call a role exempt mostly so you don't have to track its hours, even when the duties don't support it. Fifth is geography, where the employee's home state may be setting the rules, not your headquarters. Sixth is costs quietly shifting to employees' home internet, personal phones, equipment in the states that require reimbursement. And seventh is monitoring without notice, where a productivity tool trips a state disclosure law. 7 sources, 1 session. The reason I front-load all 7 is that they're connected. A timekeeping weakness feeds an off-the-clock problem. A relocation feeds a multi-state problem. By the end, you'll be able to look at your own environment and know which of these you need to go check first. Before we get into the trouble spots, let's make sure we're all working from the same foundation: the FLSA basics as they apply to remote, non-exempt employees. Let's ground ourselves in four basics, because everything else today is really a variation on these. First, non-exempt employees must be paid for all hours actually worked, and they get overtime at 1.5 times their regular rate for hours over 40 in a work week. Where the work physically happens, office, home, a coffee shop, changes none of that. Second, and this is the phrase to remember, the law counts any work the employer suffers or permits. That's old statutory language, but it's powerful. It means work you didn't ask for still counts as hours worked if you knew about it, or if you should have known about it. We'll come back to that should have known piece in a minute, because it's where a lot of remote risk lives. Third, the duty to track and record hours for non-exempt staff sits with the employer. It does not quietly transfer to the employee just because they're now working from home and you can't watch them. That's a really common assumption, and it's wrong. Fourth, there is no federal requirement to provide meal or rest breaks at all. The FLSA doesn't mandate them. But, and this is important, several states absolutely do. And that's where most remote break risk actually comes from. We'll spend real time on that later. So the core question for a remote non-exempt employee is never, were they sitting at a desk? It's, did work happen and did we capture it? Hold on to that question. It runs through the entire session. That should have known idea deserves its own discussion because it's the legal hinge for remote work. Let's talk about constructive knowledge. Constructive knowledge is one of those phrases that sounds technical, but is actually pretty intuitive once you see it in action. The rule is this: you're responsible not just for work you knew about, but for work you had reason to believe was happening. The Department of Labor put out guidance on this specifically for Telework Field Assistance Bulletin 2020-5, and it frames the standard as reasonable diligence. In plain terms, give your people a clear, usable way to report all their hours, including the unscheduled ones. Now, here's the part that's actually fair to employers. The duty is not boundless. If you've set up a real, honest reporting process and an employee just doesn't use it, you generally are not required to go digging through login records or email timestamps to reconstruct hidden hours. The employee's failure to report through a reasonable system can work in your favor. But there are two catches. The reporting system can't be a trap. It can't discourage people from reporting. And it certainly can't pressure them to underreport. And you can't look the other way. If a manager can plainly see the late-night activity and says nothing, the "we didn't know" defense falls apart fast. Picture this. Payroll notices that one non-exempt employee's emails are routinely timestamped after 7 p.m., but her timesheet always shows a tidy 9 to 5. That pattern, by itself, may be enough to put the employer on notice that unpaid work is happening. Nobody complained. The data spoke. So the takeaway is blunt. We had a policy against it is not on its own a defense. The question a regulator or a court will ask is whether you exercised reasonable diligence and whether you acted on what the evidence in front of you was showing. Let's make this concrete with the single most common remote violation I see, the after-hours message. This is the one. If I had to pick the most common wage hour violation in remote work, it's a non-exempt employee answering Slack, Teams, or email outside their recorded hours. And the reason it's so common is that it looks completely harmless. Somebody fires off a 15-minute reply at 8:30 at night, and nobody thinks of it as work. But let's do the arithmetic, just to feel the scale. 10 minutes a night, 5 nights a week, across about 50 working weeks. That's north of 40 unpaid hours a year for one person. And if those minutes push someone over 40 in a given week, you're not just missing pay, you're missing overtime. The way this becomes a real problem isn't usually one bad actor, it's culture. A manager who's always just checking in after hours sets an expectation, and the team quietly learns that being responsive at night is part of the job. Here's a situation that plays out constantly. A manager messages a non-exempt coordinator at 8:30 in the evening. "Hey, can you send me that file tonight?" She does. 15 minutes of work never logged. Now multiply that by a team and a year. And here's the sting. The chat tool created a permanent time-stamped record of every bit of it. In a dispute, that record almost always helps the employee, not the employer. So what do you actually do? The fix isn't only a policy on paper. The time either gets recorded and paid, or it genuinely doesn't happen. Set the expectation clearly that non-exempt staff don't work outside their recorded hours. If after-hours contact is sometimes truly necessary, then it gets logged and it gets paid. And train your managers out of the casual late-night ask, because that habit is where the whole thing starts. That raises a question I get all the time. What if the employee worked overtime nobody approved? Do you still have to pay it? This trips up a lot of well-run companies, so let me be really clear about it. The mistake is collapsing two completely separate questions into one. Pull them apart. Question 1. Was the work actually performed? If the hours were worked, they're owed at time and a half over 40, even if absolutely nobody approved them in advance. That's not negotiable under the FLSA. You pay it. Question 2, and it's a different question, was the rule followed? If you have a policy requiring pre-approval for overtime and the employee blew past it, that's a legitimate performance and conduct issue. You can coach, you can discipline, but you address it on the conduct track. You do not address it by refusing to pay for time that was worked. And there's a subtlety worth knowing. Simply announcing a rule against unauthorized overtime is not enough on its own. The regulations expect you to actually enforce it. A rule you publish but never manage doesn't protect you. Here's the trap in real life. A remote support rep works 10 hours of overtime in a hectic week without getting it approved first. The company pays straight time only and points to its no unapproved OT policy. That underpayment is the violation. The hours were worked. They were owed at time and a half. Docking the pay to enforce the policy didn't fix a conduct problem, it created a wage claim, and one that can carry doubled damages. So the discipline here is mechanical. Was it worked? Pay it. Was the rule followed? Manage that separately. Never let the answer to the second question reduce the answer to the first. Most of this comes down to whether your timekeeping is actually built for how remote people work. Let's talk about controls that hold up. Remote timekeeping has one defining feature. It leans almost entirely on self-reporting. There's no one watching the clock for the employee. That means your accuracy depends on system design and on habit, not on supervision. So you have to build for that reality instead of pretending it's still the old world. Let's talk about rounding, because it's a quiet source of claims. Rounding time is allowed, but it has to be neutral over time. It can't systematically tilt in the employer's favor. If your rounding consistently shaves a few minutes off the employee's side day after day, you've built a small, repeating underpayment into your own system. That's exactly the kind of thing a plaintiff's expert loves to find. You also want to capture the full working day, from the first work task to the last, including startup and wrap-up time, where those count. We'll get to startup time specifically in a couple of slides, because it's genuinely tricky. Then there's the human side. Make the right thing the easy thing. One-tap clock-in, a simple way to correct a missed punch, a low-friction way to report unscheduled time. If recording time correctly is a hassle, people will cut corners, and the gaps become your liability. And finally, reconcile periodically. Does the recorded time line up with calendars, with system access logs, with actual output? When it doesn't, that's not just messy data, that's an early warning. Here's how the failure looks. A timekeeping system rounds every entry to the nearest 15 minutes, but the workflow makes employees clock in only after they booted up and logged in to 3 applications. The rounding plus that unpaid startup consistently lands against the employee. No villain, no bad intent, just a quiet system-wide shortfall that's been running for years. So the lesson is to audit the design of your system, not just the data coming out of it. A clock that's hard to use or that rounds in one direction manufactures violations all on its own. Breaks are another place where remote work quietly creates exposure, especially the lunch that isn't really a lunch. Let's untangle breaks, because the federal rule and the state rules pull in different directions, and remote work makes both messier. Federally, here's the framework. Short breaks, roughly 5 to 20 minutes, are treated as paid working time. A genuine meal period of 30 minutes or more can be unpaid, but only if the employee is completely relieved of duty during it. That word relieved is doing a lot of work. Because here's what happens remotely. A lunch where someone keeps half an eye on their messages, or stays on call, or jumps in to help for a few minutes. That is not a bona fide meal period. That time is working time, and it has to be paid. And that creates a real problem for automatic meal deductions. If your system automatically subtracts 30 minutes for lunch, but the employee actually worked through it, you've just generated unpaid time without anyone deciding to. Now layer the states on top. Many states require meal and rest breaks and penalize missed ones, and an interrupted remote lunch can trigger those penalties. So picture this. A manager pings a remote, non-exempt employee during her unpaid lunch. Quick help, 2 minutes. She helps, but the automatic 30-minute deduction still runs. Federally, that interrupted meal may now be compensable. And in a state like California, that same interruption can trigger an extra hour of premium pay on top. The practical move: don't rely on automatic meal deductions for remote non-exempt staff, unless you have a simple way for them to flag a worked-through lunch. And tell your managers plainly, a break that's supposed to relieve someone of duty has to actually relieve them. 2 quick minutes isn't free. Now for the topic everyone asks about and almost everyone overstates: time spent booting up and logging in. Let's handle this one carefully. I want to slow down here, because this is the area where I see the most confident and the most wrong statements in HR training. So let's be precise. The question is simple to ask. When a remote employee turns on the laptop, connects to the VPN, and opens the required software before they can begin working, is that time compensable? The legal test comes from a Supreme Court case, Integrity Staffing versus Busk. The question it asks is whether the activity is integral and indispensable to the employee's principal work. Routine startup can qualify when the system genuinely is the only way to do the job. And 2 federal appeals courts have gone that direction. The Ninth Circuit in Cadena and the 10th Circuit in Peterson both found computer startup time compensable. But, and this matters enormously, those were call center cases, where the worker literally could not take a single call without a functioning computer. The facts drove the result. Here's the part people skip. Even where startup is integral, the outcomes split on a second doctrine, the de minimis doctrine. Where the startup time is very short, courts have treated it as too minimal to require payment. That's how Peterson came out, and that's how Cadena came out on remand. So the same activity can be compensable in principle and still not get paid because it's trivial in duration. Which is exactly why I want to flag this clearly. There is no nationwide rule that all remote startup time is automatically paid. It depends on the facts, on the role, and on the jurisdiction. This is an area to verify for your own workforce and your own states before you build a policy around it. So what's the safe, low-cost move? Sequence. Have your non-exempt employees clock in first, and then boot up and log in. Avoid building a mandatory off-the-clock startup routine into people's day, because that's the fact pattern that turns into a claim. And on the specifics, talk to counsel. Let's shift from how you pay people to how you classify them, because remote work puts real pressure on exempt status. Exempt status is not about a job title, and it's certainly not about whether someone works from home. To be exempt from overtime under the white-collar exemptions, a role has to clear 3 separate tests, and it has to clear all 3. The first is the salary basis test. The person is paid a fixed, predetermined salary that doesn't get chopped up based on the quality or quantity of their work. The second is the salary level test. They're paid at or above the applicable threshold. And we'll talk about that number on the next slide, including the wrinkle that some states set it higher. The third is the duties test. Their actual primary duties genuinely fit one of the recognized categories: executive, administrative, professional, computer, or outside sales. All 3. Miss any one of them, and the exempt label simply doesn't hold, no matter what the offer letter says. Remote work pushes on this in 2 directions. One is the temptation to classify a role as exempt, mostly to avoid the hassle of tracking its hours. The other is quieter. A remote employee whose real duties have drifted over time may no longer fit the exemption they were originally hired into, and nobody rechecked. Here's why this one is expensive. Take a coordinator who's classified as salaried exempt, but who actually spends the day on routine processing, with no real independent judgment and no one reporting to them. The title says exempt, the duties say non-exempt. And misclassification is almost never a one-person problem. The same job description usually covers a whole group. So every remote overtime hour worked across that entire role becomes potential back pay. One misclassified position can become a class action. The practical step is to audit your remote roles against the duties people actually perform, not the title and not the original job description. And when it's genuinely a close call, the safer classification is non-exempt. That salary level test depends on a number that's been moving around a lot lately. So let's nail down exactly where it stands today. This is the slide to get current on, because the federal salary threshold has been on a real roller coaster, and I want you walking away with the right number. As things stand, the federal salary threshold for the white-collar exemptions is $684 a week. That's $35,568 a year. And for the highly compensated employee category, it's $107,432 a year. Now, here's the history in brief, because you'll have people in the room who remember different figures. Back in 2024, the Department of Labor issued a rule that would have raised that threshold to $844 a week, about $43,888 a year, with the highly compensated figure jumping to $132,000. That rule was struck down by a federal court in late 2024. And then on May 14, 2026, the Department of Labor published a technical amendment that formally restored the 2019 levels and dropped its own appeal. So the number isn't pending anymore. It's settled at 684. I'll add one honest caveat. The DOL has signaled it may revisit this through future rulemaking. So this is a confirmed today, watch tomorrow item. If you're presenting this recording later in the year, take 30 seconds to reconfirm on the DOL site. What does this mean for you in practice? 2 things. Don't accidentally run your classifications off that old, higher 2024 figure. Some organizations geared up for it and never reset. And remember that several states, California, Colorado, New York, Washington, and Maine among them, set their own higher exempt salary floors that took effect January 1st, 2026. Where the state floor is higher, the state number controls for people working there. So the rule of thumb is simple. Test each remote employee against the higher of the federal floor or their work state floor, and recheck it every January. That mention of state floors brings us to one of the biggest sleeper issues in remote work. Which state's rules even apply? Here's a principle that catches a lot of employers off guard. For wage and hour purposes, the law that generally applies is the law of the state where the employee physically performs the work, not where the company is headquartered, not whatever the handbook happens to say, where the person actually sits and works. And that one principle has big consequences. A single remote hire in a new state can pull in that state's overtime rules, its break mandates, its reimbursement laws, its pay statement requirements, and its final pay timing. You don't get to opt out of a state's rules by being based somewhere else. There's also a tiebreaker worth knowing. More protective wins. Where a state's law gives the employee more than federal law does, the state law governs. And the reason this is a sleeper issue is that it compounds quietly. People relocate and don't tell HR. People split their time across state lines. And payroll just keeps applying the rules of the old state because nobody flagged the change. Here's the classic version. A non-exempt employee moves from Texas to California and keeps doing the same remote job. Payroll keeps running Texas rules. But the company is now out of step with California's daily overtime, its meal and rest premiums, and its expense reimbursement law. And nobody ever made a decision to break a rule. It just happened because the work location moved and the payroll setup didn't. So the practical steps are actually track where your people work and build a real process to catch relocations when they happen. One quick note. State income tax withholding and employer registration are related headaches, but they're a separate issue. Route those to payroll and tax, and keep your wage hour analysis focused on where the work is performed. Let's make the state piece tangible with 3 states that show just how different the rules can be. I picked these 3 deliberately because they show 3 genuinely different rulebooks. And if you operate in more than one state, this is the kind of variation you're managing. Start with California, which is the strictest and the most litigated. Non-exempt employees get a 30-minute, unpaid, duty-free meal period before the end of their 5th hour of work, under Labor Code Section 512. They also get a paid 10-minute rest period for every 4 hours worked. And here's the teeth. If a meal or rest period is missed or non-compliant, the employer owes 1 extra hour of premium pay at the employee's regular rate of compensation. California's framework also says the employer's job is to provide the break and relieve the employee. You have to make it genuinely available, though you're not required to police that they take it. Colorado is also a mandate state, with its own rules under the current comps order. An employee gets a 30-minute duty-free meal period when a shift runs more than 5 consecutive hours, and a paid 10-minute rest period for every 4 hours worked, or major fraction of that. One housekeeping note for whoever finalizes this deck. The comps order number updates periodically, so confirm the current order number with the Colorado Labor Department before publication. The break rules themselves are stable. New York works differently again. Under Labor Law Section 162, New York keys its meal periods to the timing of the shift. So, generally, a 30-minute meal for shifts over 6 hours that span the late morning to early afternoon window, with additional meal periods for unusually long or late shifts. New York doesn't broadly mandate rest breaks the way California does, but short breaks that are given still have to be paid. The takeaway across all 3. Break rules are exactly where remote good intentions, just work through lunch and leave early, quietly turn into per-day penalties in the strict states. Breaks are one cost. Another is the everyday expense of working from home. Let's talk about reimbursement. Remote work moved a whole category of real costs onto employees, and a lot of organizations never accounted for it. Home internet, personal cell phones used for work, electricity, equipment, and supplies. Somebody is paying for all of that, and when it's the employee, you may have an obligation. Federally, the picture is limited. There's no general FLSA mandate that says you must reimburse business expenses. The federal limit is indirect. It comes in through minimum wage. The idea is that unreimbursed business costs can't drag a non-exempt employee's effective pay below the minimum wage, and they can't cut into required overtime. That's the federal floor, and for a lot of employees, it's not where the action is. The real exposure is state law. A minority of states require reimbursement of necessary business expenses outright, regardless of the minimum wage math. And that's the gap employers fall into. A bring your own device, use your own home setup arrangement that's silent on reimbursement is perfectly fine in most states and a clear violation in others. So here's the risk in one sentence. A single national policy of we don't reimburse home costs is lawful in many states and unlawful for your employees in the states that require it. The practical step is to figure out which of your remote employees actually sit in reimbursement states, and then set a defensible method for the recurring categories, internet and phone first, because those are the ones that come up every single month. Let me show you the two states that make this most concrete, California and Illinois. These two are the ones to know, because they're the most developed and the most frequently litigated. California's rule is Labor Code Section 2802. It requires employers to indemnify employees for all necessary expenditures they incur in doing their job. And California courts have applied that squarely to remote work, a reasonable share of home internet and personal phone use, plus equipment and supplies. Here's what makes it bite. Section 2802 also lets employees recover interest and attorney's fees. That's the mechanism that turns a modest per-person amount into a claim that's genuinely worth bringing. Illinois has its own version, an amendment to the Wage Payment and Collection Act, 820 ILCS 115/9.5, in effect since January 1, 2019. Illinois requires employers to reimburse necessary expenditures within the scope of employment that primarily benefit the employer. Illinois does allow you to set reasonable parameters through a written reimbursement policy, but that policy can't be a backdoor to reimbursing nothing. Both of these laws reach the everyday categories, connectivity, and personal device use for work, not just big-ticket equipment. Here's the scenario. A remote employee in Illinois uses her personal phone and home internet for work every single day. There's no reimbursement, and there's no policy that even addresses it. Under the Illinois statute, those necessary employer-benefiting costs are reimbursable, and the fact that there's no compliant policy in place actually weakens the employer's position rather than helping it. So the blunt version is this. We've never reimbursed anyone for home internet is not a defense in California or Illinois. It's just a description of the violation. If you have remote staff in those states, get a written reimbursement method in place now. Cover the recurring connectivity and device costs, and keep records of what you paid. There's one more remote work tool that creates risk in an unexpected way: monitoring software. Let's talk about the privacy and notice side. A lot of organizations rolled out productivity or time tracking software for remote teams, and used the right way, it can actually support accurate timekeeping. But how you deploy it creates a second risk that has nothing to do with overtime. It's about employee privacy and notice. At the federal level, the Electronic Communications Privacy Act generally permits monitoring on employer-owned systems under business purpose and consent principles. But several states go further and require you to give notice. New York is the big one here. Under its civil rights law, Section 52C, in effect since May 7th, 2022, private employers who monitor email, phone, or internet use have to give employees notice on hire with an acknowledgement and post that notice conspicuously. Connecticut has its own notice requirement, and so does Delaware. The details vary by state, but the through line is tell people in writing before you monitor. And here's the part that ties this whole session together. Monitoring data cuts both ways. The same activity logs you're using to prove productivity can also prove hours worked, including the off-the-clock time you didn't pay. You can solve one problem and document another. So picture a company that rolls out keystroke and activity tracking across its remote team without any monitoring notice. In New York, that missing notice is its own violation. And at the very same time, those activity logs may be quietly documenting unpaid work hours. One rollout, two exposures. The practical sequence. Before you deploy monitoring, provide the required notice and acknowledgement in the relevant states. Document your business purpose, and decide in advance how that data is going to interact with your timekeeping, because someone will eventually ask. We've covered a lot of individual risks. Let's step back and talk about why these matter so much in the aggregate, the litigation and enforcement picture. Here's why wage and hour gets the attention it does, and why small problems deserve real seriousness. These claims are uniquely scalable. The reason is that the same practice almost always affects an entire group of people, not just one. One auto-deducted lunch, one rounding quirk, one misclassified role. It's rarely isolated. That's why these cases become collective actions under the FLSA and class actions under state law. Now stack up the math. Federal back pay reaches 2 years, or 3 years if the violation is found to be willful. On top of the unpaid wages, the FLSA allows liquidated damages equal to the unpaid amount, which effectively doubles the back pay number. Attorney's fees are recoverable by employees who prevail, which shapes whether a case gets brought and how it settles. And then the state add-ons stack on top of all of it. In California, those meal and rest premiums, wage statement penalties, waiting time penalties, other states have their own. And it's not only private lawsuits. The Department of Labor's Wage and Hour Division and state agencies investigate, and they can order back wages directly. So the dangerous feature here is multiplication. Take a small per person per day amount. Multiply it by many employees. Multiply that by a multi-year window. Then double it for liquidated damages. Then add the fees. That's how a habit nobody thought twice about becomes a number that gets the C-suite's attention. This is the whole reason those minor remote timekeeping habits we talked about deserve real care. The individual amounts are small. The aggregate is not. So how do these problems actually begin? Almost never the way people expect. Let's look at how they start. I want to demystify this because there's a tendency to assume wage violations come from bad actors cutting corners. In remote work, they almost never do. They start from convenience and goodwill. It's the helpful employee who jumps on a message at night. It's the busy manager who says, just this once. 4 ignition points show up over and over. A manager who normalizes after-hours contact. An auto-deducted lunch that nobody ever questions, a quiet relocation that payroll never hears about, and a classification that was set years ago and never revisited as the job changed. The reason these stay hidden is that the symptoms are small, and this is the key part. The affected employees usually aren't complaining. They're being helpful, not aggrieved. There's no angry email in your inbox tipping you off. And then it surfaces at the worst possible moment. A termination, a DOL audit, a disgruntled departure. One employee who happens to mention their hours to a plaintiff's attorney. So here's the mindset shift I want you to leave with on this slide. You will not get your early warning from a complaint. The early warning is sitting in your own systems, in the chat logs, the access records, the timesheets that look just a little too clean. If you wait for someone to raise their hand, you've waited too long. If those small things do get ignored, what's actually on the line? Let's name the outcomes plainly. Let me put the consequences on the table directly, because it helps to be specific when you're making the case internally for fixing this. First, back wages and overtime owed across a group, and reaching back 2 to 3 years. Second, liquidated damages, which under the FLSA can double that unpaid amount. Third, state penalties stacked on top in California. The meal and rest premiums, the wage statement penalties, the waiting time penalties, and the equivalents in other states. Fourth, the plaintiff's attorney's fees, which in these high headcount, smaller value cases often end up exceeding the underlying wages themselves. Fifth, reimbursement liability in California, Illinois, and the other states that require it again, with interest and fees. And sixth, the cost that doesn't show up on a settlement sheet, reputation and retention. Being known as the employer that didn't pay people correctly has a real price in a tight labor market. And the thread running through every one of these is that a single overlooked practice, the auto-deducted lunch, the unpaid startup, the misclassified role, rarely stays a single employee problem. So weigh the two sides honestly. The cost of fixing this now is a policy update, some manager training, and a payroll review. The cost of ignoring it is measured in multiples. That's the trade. And when you frame it that way, the business case for acting usually makes itself. Good news, most of this is genuinely fixable, and a lot of it you can start on this quarter. Let's talk about what to audit now. Let's get practical and turn everything we've covered into a review you can actually run. 6 areas. Classification. Test your remote exempt roles against the duties people actually perform and against the higher of the federal or work state salary floor. Timekeeping. Confirm the system captures the full working day, that rounding is neutral, and that people clock in before any required startup. Off-the-clock work. Go look for after-hours activity among your non-exempt staff and reconcile it against recorded time. Breaks. Confirm meal and rest compliance in your mandate states, and stop relying on automatic deductions where lunches are getting interrupted. Reimbursement. Identify your California, Illinois, and other reimbursement state employees and put a written method in place. And monitoring and geography. Verify that you've given the required monitoring notices and confirm that you actually know which state each remote employee is working in. The one piece of advice I'd add: run this as a deliberate review, not a one-time memo that goes out and gets forgotten. The reassuring thing is that most of what you'll find is quietly fixable before it ever becomes a claim. You're not looking for disasters. You're looking for the small drifts while they're still small. There's one control that matters more than almost any policy, and that's your managers. Let's talk about training them. Here's something that took me a while to fully appreciate. Most remote wage hour risk is created or prevented by a manager's everyday behavior, not by a policy document sitting on the intranet. The manager is where the rubber meets the road. So managers need to genuinely understand a few concrete things, not in legal language, but in plain terms. Don't casually ask non-exempt staff to do work outside their hours. Don't interrupt protected breaks, and all worked time gets paid approved or not. Teach that approval versus payment distinction directly, because it's the one managers get wrong most. You can discipline unauthorized overtime if you need to, but you pay it first. Give them a simple escalation path too. Relocations, schedule changes, the employee who always seems to be online late, those should come to HR and payroll quickly, not sit with a manager who doesn't realize they matter. And reinforce that chat and email set expectations. A late night, "Hey, can you just," from a manager isn't a small thing. It's how an off-the-clock culture gets built, one message at a time. Here's the scenario that captures it. A well-meaning team lead praises a non-exempt employee for always being available. He thinks he's recognizing good performance. What he's actually done is tell the whole team that unrecorded after-hours work is what good performance looks like. No bad intent and a real problem created. So the bottom line is this: you can't directly supervise remote work, which means the manager is your control. Train the behavior, not just the rule. Let me leave you with something you can take straight back to your team: a checklist. Here's your take-home: 10 items. If you can honestly tick these, the common remote wage hour claims have very little to land on. Every remote role correctly classified against the duties and the right salary floor. A genuinely easy, honest way for non-exempt staff to record all their hours, including unscheduled time, without anything that discourages reporting. Timekeeping that captures the full workday with neutral rounding and clock-in before required startup. After hours and interrupted lunch work that's identified, recorded, and paid. Meal and rest compliance confirmed for each mandate state you operate in. A written reimbursement method in place for your California, Illinois, and other reimbursement state employees. Monitoring notices provided where they're required: New York, Connecticut, Delaware, with the business purpose documented. A real process to learn when someone relocates or changes their work state. Managers trained on off-the-clock work, overtime, breaks, and escalation. And finally, a calendar reminder to recheck state thresholds and rules every January, because these numbers move. Take this list back to your team and use it as the agenda for your review. The emphasis is on honestly. A checkbox you can't truthfully tick is exactly where you want to spend your time. Let me pull it all together with the few things I really want you to carry out of this session. If you remember nothing else, remember these 4 things. First, remote work didn't create new wage hour law. It removed the visibility that used to keep employers compliant almost by accident. So the discipline now has to be deliberate. You have to go looking, because the work won't walk past your desk anymore. Second, the risk is small and frequent, not large and rare. It's minutes, lunches, and after-hours messages, multiplied across people and across years. Respect the small stuff, because the small stuff is the whole game. Third, geography is destiny for a distributed workforce. The employee's work state sets the overtime, the break, and the reimbursement rules, not your headquarters and not your handbook. And fourth, the cheapest fixes are the ones HR already owns. Clean timekeeping, honest reporting, correct classification, trained managers, a written reimbursement method where it's required. Fix the systems and the manager behavior, and most of this exposure simply never accumulates in the first place. So I'll leave you with this. Remote wage hour compliance isn't about watching people work. It's about making sure the way you pay them keeps up with where and how the work actually happens. Get that right, and the rest tends to take care of itself. Thank you all for the time today. And remember, this has been an educational session, not legal advice. So for your specific situations, confirm the details with your counsel and your state's agencies before you act.